Tube should be up on the VTF. I'm running 2 minutes late. Let's get started. I am an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. These are my positions. Cut them down a lot. Even got out of AMC today. All right, so let's jump into it. Oh man, whew, this market is so crazy. So we are officially. Let me turn on my camera here. We are officially in a market correction for the IWM. Just one of the reasons why I'm running a little late on getting this meeting started. I was just doing some quick percentage math here on a closing basis, which is really the right way to do it. It's the way, whatever, it's normally done. I actually always prefer to do from absolute highs to absolute lows. It's just easier. But on a closing basis, closing highs to where we are currently, the IWM is now down a little bit over 12%. That's opposed to the SPYs here, which are down just a little bit over 4% from their highs, so nothing too much. And the NASDAQ is down also just a little bit over 4% from its all-time closing highs. So SPYs and Qs, you know, it still kind of feels like it's nothing. But again, we know that a lot of these stocks are in absolute bear markets, like depressions. And obviously even the IWM, which is by far our worst index, is not in a bear market. It's just it's bearish, but not in a bear market. It's only down 12%. The bear market officially starts at 20% from highs. So that is some percentages there. And I like to do that once in a while because it's worth doing that for some perspective. And it's just the unique thing about this market, and I've said this a lot, the unique thing about this market is that we're down so little in the S&P, yet there are so many stocks that are in like absolute bear markets and depressions on the month, from month highs, let alone from their year highs. So it's a really interesting environment. But like I'm saying, I like to just think about those percentages just because I can think about those percentages in terms of like more historical statistics and historical averages. Like on average, historically, I think the S&P sees a 10% correction every 7 or 8 months or so. So almost 2 a year, not quite 2 a year. And we haven't seen that, right? The SPY, I don't think we've seen that even all year, honestly. The NASDAQ I know has, and the Russell certainly has. It is right now. But even right now with this pullback, the S&P is only off about 4% on a closing basis from its all-time highs. With that said, obviously things are looking pretty bad. The S&P now has also had a false breakout, big picture false breakout, which we were already talking about with the IWM. You know, the Russell here had been in this year-long consolidation, had a breakout right in the beginning of November, only to now have that breakout fail. And then we know, this is basic technical analysis, from a failed move comes a fast move. So sure enough, from a failed move here, failed breakout in the Russell 2000, we now have a very fast market correction for the Russell. And we're actually almost at year-long support. Support from this entire year here is this, I would say it's the space between like 207 and 210. For the Russell. We're just a few bucks away. And considering today's range, I mean, what's today's range in the IWM? High is 224 and low is 213. We had an $11 range here for the IWM. We could very easily be seeing that 207 to 210 area tomorrow. It's only another $3 to $6, only $3 to 210 from where we closed. So it's an incredible market right now. We'll see if we get the gap down tomorrow that we kind of all want. You know, it does tend to be when the market closes this week that you get a gap down the next day. with that said, we've kind of consistently noticed recently that whenever we want that big gap down, like if we get a big gap down, like the IWM gaps down to 209 tomorrow, I think you have to be a buyer. Because at that point we'd be kind of ridiculously extended to the downside. And it would be day 1, 2, 3, 4. It'd be day 5 to the downside. It would be extremely extended, and you would have a large common gap down into support. So I think if you see us, trading in the morning between like 207 and 210, you got to come in and you got to start doing some buying. That's where your real dip buying kind of comes into that degree of extension, or at least a short-term bounce, and then we'll obviously take that as it comes. I had spent some time a couple of weeks ago when the market was still fully at highs, talking about some of these beaten up stocks, and I was like, we keep talking about this juxtaposition between the NASDAQ holding up as well as it is, now down only 4%, and some of these stocks. And some of them are kind of real companies. It's not just like the Wish type names that are out there. It's Twitter, it's Snap, it's DKNG, it's some very real stocks in there. PayPal, Zillow. Some real companies that have been down for a long time, have been involved. We've been involved with for a long time. A lot of those things, even last week, were down on the month 20 to 40%, and down on the year 40 to 80%, and they've even further continued today. I mean, what did Fubo like? And look at these. Some of these daily charts are just so crazy. Look at that, right? Fubo down another 10% today. DKNG down another 10% today. PayPal only down 3% today. Just completely brutal how some of these stocks have been selling off here. So that's been the big question I had was, well, what happens if the market itself actually sells off? Like, can these things just continue from where they are? And the answer to that is yes, and that's what we expected, right? Because when the market sells off, they sell everything. They don't look at some names and go, oh, this one's oversold. Oh, this one's already down, 40% on no news. They say, all right, we need cash. We need to raise funds. We need it now. We are liquidating. And the interesting or difficult thing about today was how bullish we looked for part of today. And, the SPYs themselves were only down a percentage point, as opposed to the Russell here down 2.3%, the NASDAQ down a percent and 3/4. But again, the interesting thing here was just we had textbook bullishness for this market up until 11:25. Really, we had textbook bullishness for the market up until 12:50 today. We had a pretty big gap up this morning, which I did think was making things difficult. I don't think that it was enough to come in and short, but it was a big enough of a gap up where it was difficult to do a lot of buying. So the game plan, very similar to Monday, was to be patient this morning. Let's be patient. Let's see what this market is able to do. Let's see what happens here in the first 30 minutes or so. I specifically said to the team, I want to see what happens when these small time frame moving averages catch up to the price action. And it was textbook. SPYs, Qs, and IWM all spent the first 30 minutes going sideways. This is a bullish consolidation. It's digesting this big gap up. And when do you tend to get upside continuation of that gap up? Right as the ADMA catches up. And that's exactly what happened. And I called that out to the team on the VTF here at 9:55, 10 a.m. I was like, all right, guys, we went sideways here for 30 minutes. We were patient, just like we were looking for. The ADMA is now caught up to the base of price action. Let's see if that ADMA starts pushing us up higher. And that's exactly what happened. We got new highs in all three indices. Then I noted when I was getting off the radio at like 10:25 today, I was like, all right, now we're approaching 10:30, so I would expect a 15-minute timer price correction. Well, guess what? We got a perfect 15-minute price correction right as I said that. I can switch over to a 15-minute bar here, or 15-minute chart here. You can see SPYs perfectly pulled down almost into the ADMA on their 15-minute. Qs here kiss their ADMA on the 15-minute, and IWM basically does the same thing. Does exactly what it's supposed to do. And then off of the 15-minute correction, guess what we get? Higher prices. This is all perfect technical bull price action. Everything looks normal and good. We push higher here a little bit, and now it's midday. And what often happens midday is we get a lot of, choppy price action, kind of back and forth price action. So not unusual to see us rolling back down here a little bit, maybe even pulling a little bit deeper than you would like and going sideways. And it really wasn't until, closer to 1 o'clock that we actually started to have some real selling and starting to break lows, led by the IWM. The IWM was the first one to kind of show us concern here. The SPYs and Qs look like they just wanted to go kind of into consolidation mode, whereas the Russell was actually breaking to new lows on the day. So Russell was our first signal, and then we started to get the news, which I think is expected, was bound to happen, that the Omicron variant, whatever you call it, has made its way into the United States. We got the first case in California. It's funny to just talk about, I guess, COVID for a second and its effect on the market environment. I was the guy, and people who were on the team back then know, I was the guy in 2020, January 2020, like yelling from the rooftops that we need to be shorting this market because this COVID thing is in China and it's probably going to make its way global. And I remember very specifically saying in the VTF in January, just imagine if we get one case in New York, what that could do to this market. And I was saying that in early January. My biggest issue was that I shorted too early. And we, had a little bit of a pullback into the end of January, and then we're just consistently making new all-time highs every day in February until exactly what happened, what I said was going to happen, happened. We got that first case in New York. It started blowing up here, and then we all know what happened. So I was the person yelling from the rooftops about how devastating COVID could be to the marketplace in the beginning of 2020, and I'm not that way on this one. I'm really not. I do not think that we're going to go back into a national lockdown. It'd be terrible for the global economy. I just don't think it's going to happen. So first of all, this variant seems like, though one of the other bad pieces of news that we got today was that hospitalization rates in South Africa were increasing. But it seems like broadly the symptoms from the new variant are actually pretty mild. And there's just no way we're going to go. I just genuinely believe that there's no way the United States as a nation, you might see pockets of it, maybe California, New York City, whatever, could go into various degrees of a lockdown. But there's just no way that we're going to do this nationwide. The people in the United States would just be rioting on the streets, and I think it would be political suicide for the Biden administration, which already doesn't have the best ratings, whatever you call that, in the world right now. And like we always talk about, when we're trying to figure out what decisions we expect to come from anybody, you want to think about incentives. What's the number one incentive of the political administration right now? What are they trying to do first and foremost, more than anything? Is not necessarily to help the people, it's to get reelected. That's what they want to do first and foremost. And I think if they put us back into another lockdown, it's just going to be political suicide for them. They're just not going to do it, and the people would be rioting. So I don't think that's going to happen, and I do think that this variant is overblown. But I also think that the sell-off in the market here is not entirely COVID-based. I know a lot of you guys in the VTF have said that as well. I think it's a confluence of factors here that are really all coming together all at once. And the biggest thing is Jerome Powell yesterday, I do think, really slipped up. I don't understand. I understand tapering. I understand higher interest rates. I mean, again, you go back to 2013. I know it was a long time ago, but I was saying back in 2013, hey, the economy is fine. Why are we still doing QE infinity? Why are we at zero interest rates? We need to start raising interest rates and slowing down the market. 2013, the S&P was up 33% on the year. We need to start slowing down this economy and slowing down this market and putting our weapons, our tools back in the tool bag for, you know, our economy in case the next bad thing happens. And we got off to such a slow start with that. And then eventually Jerome Powell tried to raise interest rates, and you know, everybody flipped out. And even when Powell did it, it was what, 6-7 years too late as far as I'm concerned. You know, when coronavirus eventually came around, we couldn't lower interest rates anymore. All we could really do is start picking up the asset purchases, and that's what we did. So, but you know, for the timing of right as the market's getting fearful on this new variant, to then say, it's one thing to say, you know what, we're planning on staying the course, but to then come out and say, you know what, we're actually going to increase the speed of tapering and try to get us potentially closer to interest rate liftoff even sooner. I just think that threw an extra variable in there for the market that the market just didn't like. And again, it makes perfect sense to me to go back to this list of stocks here. It makes perfect sense to me that some of these names should be down as much as they are. Like, I was talking to somebody, I was looking at Palantir today. You know, I remember when Palantir IPO'd at $10, and I thought that the stock was worth $5. And then obviously it had this insane run. I tried to be shorted. I lost some money at a certain point trying to be short. And this is back when, you know, the market was just bubbling everywhere, and I was calling it a bubble at that time. And now, you know, it doesn't not make sense to me for some of these stocks to be down 75% on the year. It doesn't not make sense to me for them to even be down, you know, 20-30% on the month. They should be. If you are a growth company that's not growing and loses money and interest rates increase, it's a recipe for bankruptcy. So maybe some of these stocks I'm talking about, like your Fubos of the world, you know, and especially the really garbage ones, you know, like a Wish or a Skills or, you know, maybe even a Jumai, like something like that. Maybe these things really are zeros in a higher interest rate environment. I don't think it's that way for all of them. Like, I do think that there is real value in like a DKNG, but it doesn't mean that maybe DKNG belongs at $15 on a higher interest rate world. Maybe this Fubo belongs at $10 in a higher interest rate world. I mean, that's where it came from. You know, it came from 10. Palantir came from 10. You know, maybe we're a long ways away from that still. But the rate of descent here has been pretty crazy, and it's not like, you know, we're hiking up interest rates to 4% by the Fed like next week. I know the market's a forward-looking mechanism, so it makes sense to discount these stocks based on higher interest rates. But it's still a crazy move, and now that we're seeing more broader selling, it's certainly not helping those stocks. So, you know, we'll see here. You know, these Qs are potentially getting a little bit broken as well as they lose this 390 support. We could definitely see bigger downside price action, but I think at least short term, a gap down tomorrow is a buying opportunity. We're just going to be massively oversold on so many metrics, the sentiment metrics, the way that I look at extension is, you know, the space between where the stock is trading from where the 8 and 21 EMA is. We're going to be really super extended to the downside on a big gap down tomorrow. We're extended even right now. And I'd be curious to know where like the McClellan oscillator is, because I don't have that information. I don't look at it very often, but once in a while I'm curious. Square is changing its name to Block. What's Square doing on that? Anything? Trading up $3. My initial reaction was, oh, Square's trading down on that, but no, it's actually trading up $3. It's just destroyed. Square actually has some pretty big support here at $193. So that's kind of pretty much it. You know, there's not too much to be said about individual names except for maybe Apple. You know, Apple was interesting because it started the day with maybe didn't start the day, but pretty quickly into the trading session, we were seeing a continuation of the Apple bull flow that we saw yesterday, and it just looked like this thing was going to be unstoppable. And then it broke through that 170, little baby shooting star candle on no small time frame extension on a little higher volume, and then some bear flow started coming in, and the whole market got destroyed, and this thing completely rolled over and was even able to go a little bit negative. So I think that's all she wrote. I could go over individual stocks, but I don't think that there's anything to go over. It's all about the big picture right now. Correlations become very high in market sell-offs, and that's exactly what we're dealing with on everything. Everything is starting to sell off here, and even that Apple, which has been the strongest stock that's out there, gave a pretty gross looking daily candle here. But again, all this candle means is maybe a pullback to 162 for Apple, which is still above yesterday's high. So that's it. If anybody wants me to look at any specific individual names, I'm of course happy to do it, but I don't really have any that I feel compelled to go over today, even though I typically do. It's just really all about this volatility. I guess just one more comment about volatility in general. So first of all, as volatility increases, it generally becomes a good practice for traders to implement smaller tier sizes and a little bit wider risk than they would otherwise. So that's a good thing to remember. The same P&L swings that you might get on a 1,000 share position in typical times, you might be getting on a 200 share position now. So definitely keep that in mind. I know my personal P&L swings today were exhausting. I was up a tremendous amount of money at one point today when the market was highs, and then I closed down a very solid amount of money, and I actually felt I traded really well today. But it was still, my swing positions just giving back boatloads of profit in that market sell-off. So volatility has really increased, so you got to keep that in mind. And the interesting thing about this market only being down 4% is I feel like the percentage swings we're seeing right now are some of the biggest I've ever seen in my career. It's not as big or as crazy as what we saw in March 2020 when the market was literally going limit down at some points. But this IWM specifically, the Russell was up like 3% at one point today, about maybe just a little bit under, and right now is down 2.4%. That's like a 5.5% move from highs to lows. It's an $11 range from highs to lows. That is a big move. That is a really, really big move. Some of the biggest I think I've seen. So that's it. That's all I got. Happy to answer any questions. I'm going to scroll up here into the VTF to about 10 after 4. We work to restate financial statements as of December 31st. So that's not good news at all, right? WeWork is unfortunately for me, because I have a position in it, down nice and solidly after hours here. First question I'm seeing is from Chingus. How do you identify the stock's correlation to the market to a specific ETF? For example, WOOF. I was not able to find it in any of the ETFs we look at throughout the day. I just want to understand which ETF to look at to identify correlation and relative strength weakness for a specific stock. I tried ETF.com and Yahoo Finance, but that takes time to look up and apparently does not have that ticker. Did you just end up naturally memorizing it all throughout the year? No, I definitely haven't naturally memorized the holdings of every ETF that's out there over the years, and I don't even know, all 400 and whatever holdings in the S&P 500. Did the S&P 500 get back to 500 stocks? Because last I checked, it was only 400 and something, which is interesting. There is going to be some degree of correlation to probably any stock that you look at, and let's just say the S&P 500. The S&P 500 is generally considered to be the broadest indication of the market as a whole, though in kind of recent times, I actually have been leaning more towards looking at the IWM. I think that the Russell 2000, and I'll tell you why. I think that the Russell 2000 has actually become even more indicative of the average stock than the S&P 500, and it's just because the market cap weightings of the S&P 500, it's like Apple can hold up, and the whole rest of the market can sell off, and the S&P can kind of hold up because of it, right? So even something that's not in the S&P 500 though, or is not in the Russell 2000, is still going to have some degree of correlation with it, and that's just because of the way that markets kind of function, especially with all the algorithms that are out there, where if you've got, Pat spends a lot of time in his very professional morning note each day talking about like fund flows, and like the vol control universe is a thing that he talks about a lot. You can ask him. He understands it honestly better than I do. So next time Pat does an afternoon meeting, you can ask him for more specific details on it. But when you got these big funds that are primarily executing through algorithms, and they, based on their protocols, mandates, strategy, programming, whatever you want to call it, are de-risking. That means that they're de-risking across the board. So if a lot of those holdings that they're de-risking are probably going to be in the S&P 500 or Russell 2000, but even a stock like Wolf, which is probably not, to use your example, will still be subject to that broader de-risking selling that could be coming from some of those big funds that are out there. So there is going to be a degree of correlation with everything. Now, you're going to have things and sectors and stocks that have lesser correlations and more and heavier correlations. For example, like you could look at a Chinese company like an Alibaba or JD.com or whatever. Those are still going to have a correlation to the S&P, but that correlation should naturally be lower because it's not even an American company, right? They're Chinese companies. So why would they move because of the S&P? Well, because for the same reason why it's decently probable that the Asian European markets are going to be down tonight because they're going to be following the U.S. markets lower. We're in a global world right now. And then, just broadly, you could pay attention to if you know that a stock is in a certain sector. Like, here's another example. I'm pretty sure, maybe someone can double check on this one. I'm pretty sure that SoFi is not in the XLF. But I still will sometimes when I'm, as you guys see, because I'm sharing my screen in the VTF, especially in the mornings, you see that I'm constantly typing up stocks. So you'll see that chart, that I'm sharing, which is linked to my main market maker, constantly rotating through ETFs, the exchanges, individual stocks. So even though I'm pretty sure SoFi is not in the XLF, I will look at XLF real quick sometimes versus SoFi to have an idea of what they're doing, because SoFi is a financial company. It's applying to be a bank, whatever. So you have that, potential degree of correlation. And then you see, well, are things acting stronger or weaker? Is the XLF stronger or weaker to the S&P? Is this stock that you're looking at, is Wolf looking at, stronger or weaker than the S&P? Even if it's not part of it, it's still a piece of information that is worth noting. So I hope that helps to answer your question there, Chinggis. Thank you for the question. Oriel saying that PBI. Yeah, this is another safety trade, even though it's gone from a high of $8.20 to a low of $6.65 here. It's supposed to be like a value type play. There's huge support. Sorry, excuse me. You do have huge support into this like 665 zone. So see where it opens tomorrow. You can take a look at it. There's news on this DWAC that came out basically into the close. They got some financing. I'm going to advise people to generally stay away from this stock. The way this moved last time easily could have been career ending for people. Sorry, excuse me. Got a little stuck in my throat. Yeah, same thing. What Noah's saying here: news correlation, news earnings, that'll greatly lessen the stock's correlation as well. Oriel saying IWM at 209 would be a gift. I think so too if we can get that gap down. I'm concerned that we won't. You know, most of the time when we really want that big gap down, we don't get it. But hey, look, we are already trading down a little bit more after hours, so why not? From Justin here. Since the month just ended, could you explain what you do to review your month and your monthly journals, specific for day trades? As I'm a newer trader, and most of my trades are day trades. Sure, Justin. I have a whole class about journaling in the training program, so I definitely would recommend that you take a look at that because it gets into a lot of detail, more detail than I'll probably get into in this afternoon meeting today. But you know, daily journals, weekly journals, monthly journals. Monthly journals are the most comprehensive that I recommend that people really keep, and it's going to be a review of the month. You know, I used to get into tremendous amount of detail doing my monthly journals. I would spend my entire Sunday putting out my monthly journal. I would sometimes spend anywhere from 2 to 8 hours doing a monthly journal on a weekend after the month had ended. And, you know, I basically would review not every trade that I took, but I review all my old journals from the month, daily journals, weekly journals, and I would review like my 5 best stocks on the month, my 5 worst stocks on the month. I would review my best days on the month, like 5 best days on the month, my 5 worst days on the month, trying to see, you know, what I did well, what I did poorly, trying to identify my personal strengths, my personal weaknesses, and then I would establish goals for myself for the next month based on that review. You know, what do I need to improve on? What can I do for myself? What are realistic P&L goals, consistency goals? And then I would kind of put that together, you know, a big thought process on what adjustments I need to make and, you know, what I am already doing well and what I can continue to do well based on that information. So that's kind of a short answer for you there, Justin, but check out the class. It's probably like an hour-long class on it. Yeah, volume tends to be higher in market down moves than up moves. We're seeing that here. Wow. You know what's interesting, though? I guess I still have the IWM up. But look at the volume here compared to the volume in the height, the bottom of the actual sell-off in 2020. It's getting there. It's actually getting there, which I think is notable. SPYs are not. That's in the IWM. I take it back. SPYs are nowhere near what they were doing volume-wise, but the IWM sure is. And that also kind of shows you that weakness in the IWM compared to what we're seeing in the SPYs and the Qs right now. SPYs are not even doing half of what they were doing in March 2020. What about the Qs? Yeah, Qs as well. They're a far cry away from what they were doing in March of 2020. Granted, we're also dealing with a more expensive marketplace. But yeah, volume has really picked up for sure. Let's see here. Yeah. Thanks, Dan. Thanks, Rowan. From Eddie K, the risk reward of a lockdown isn't worth it. We saw it the first time. Yeah, I'm in agreement with you. Penny here. I think everyone is thinking the show must go on. We have to learn how to operate in a world with new variants. Can't stay at home forever. I agree, but the market sure ain't acting like it, right? This sell-off is getting wild. From Rich, with all the talk about tapering and higher interest rates, why are banks still so weak? So, well, this is another one of the really interesting things. That's a great question. This is another one of the really interesting things I spoke about in yesterday's afternoon meeting, is that all this talk about early tapering, all this talk about pushing forward the increase in interest rates, well, what should be happening? Right? The market's a forward-looking mechanism. So if interest rates are supposed to be moving higher in the near future, they should be moving higher now. If they have to move higher in the near future, they should be moving higher now. And the exact opposite is happening, which I'm sure Uncle Jerome was looking at this. The language he had yesterday is having the opposite effect of what he wanted to have, I'm assuming, on this marketplace. The market is so scared right now. There's a flight to quality. There's a flight to safety. That's why we saw, honestly, let me rephrase that. There's not a flight to quality going on. They're selling off everything, with the exception of a few safety plays, honestly, like Apple, and they're buying up treasuries, right? Treasuries are the ultimate safety play, even though you can't get any return from them at all right now. They're that ultimate safety play. The TLT broke out today. Interest rates are breaking down. That's bad for banks. That's why banks are going down. And this is like, and I mentioned this really briefly in yesterday's afternoon meeting, this is like one of the really scary things to me about this market. This is probably the scariest thing to me about this market right now, is that he said the wrong things yesterday. He really did. He spooked this market really bad. Interest rates are going down right now as Powell's trying to get them to go up because he's worried about inflation. Because the market is just so spooked by that whole entire concept. So it's just really interesting to see here this TLT trading above 152. And that's bad for the financials. It's bad for everything. It's bad for everything. If they're unable to really properly raise interest rates and unable to tamper down inflation, and we're having threats of a lockdown and whatever else, which I still don't think is going to happen, this is almost like a worst case scenario here for the market when you look at the TLT in conjunction with everything else. It's really scary. We need this TLT to have a false breakout here. The same way the IWM and now the S&P have had false breakouts. We need this TLT to become a false breakout and get back below that 152 ASAP. It's pretty extended here, so we'll see if it's able to do it. But I don't know. It's pretty wild. Pretty wild. And again, that's bad for banks. But at the same time, Powell tried to come out today and calm the market down a little bit by saying that he still expects inflation to come back down in 2022, which I'm still kind of, I know we're not using the word transitory anymore, but I'm still kind of in that camp too. We saw wage increases, particularly for the bottom cohort of people. That's actually not a bad thing as long as prices don't really start escalating along with them, which they obviously already have. But I'm still in the process. Like, if you actually look at the inflation numbers, like a large portion of the inflation, as an example, has come from like car sales and used car sales, right? And obviously it's more broad-based than that, but that's been a really big one. And a lot of that stuff is supply chain issue related. So if you can tamper down the supply chain issue, and I'll tell you what else, the federal government, and you can make arguments on whether this is the right thing or the wrong thing to do. There's several arguments to be made. But if we're talking about just pure inflation, just very specifically inflation and not anything else, you got to get rid of these tariffs. The Trump tariffs that Trump put on that Biden has continued with increase the cost of goods and it increases inflation. So we got to get rid of these supply chain bottlenecks, which I think will improve. And if you want to tamper down inflation, get rid of tariffs, and that'll help with it as well. But right now, this TLT chart is very scary to me. From Mr. Steven, I see, how bad is the inflation issue? Can inflation rate get to 10%, 12%, etc.? Maybe the governments need to slow the economy down, as they can't really raise interest rates like in the 70s with so much debt to finance. And that's the other big scary part for sure. Overreaction to the variant and Powell's comments are not a good look, in my opinion. Yeah, I mean, I definitely broadly agree with you there, Mr. Steve, and a lot of the answer to your question, I guess, would go back to what I just said. I think that there's other ways we can be looking at to bring down inflation if it's a real big fear, and I do still think that if we can move forward with these supply chain issues, which should happen with time, that we'll get improvement there as well. Square is renaming itself to Block. Yeah, I think you want to. So the question here from PT Rain, if I'm saying it correctly, is what I look at 162 as a buy for Apple. That area, Basically this type of candle typically means a retracement, a correction, I should say, through time or price to the equilibrium area. The equilibrium area is the space between the 8 and 21 EMA. So currently that would be a move down to between 161 and 156.50 for Apple. So it really would be in that area. But as time happens, these moving averages are going to be moving up as this comes down. So, I mean, maybe we see a massive sell-off continuation tomorrow and this thing's at 157.50 by the end of the day. But more than likely, this is going to have time to be moving higher as this comes down. So I would start to look at it at 162. You also don't want to see Apple lose the positive Maribozu candlestick low from yesterday. Yesterday was a big breakout day on beautiful volume for Apple. You don't want to see it lose this 159.92. So you got the ADMA right now at 161. That should continue to move higher by a little bit. You got the Maribozu low at 159.92. So I would start looking at the area at around 162 to start looking for signals for a buy. And that's also kind of where we broke out from. So the space between like 162 and 160 is where I'd be watching it closely on smaller time frames to see if we can get a buy. Next here from Gabriel. For a huge gap down, which stocks do you think are better to look at from the trash list stock? Also, if there is a pure market opportunity, you only recommend trading an index. Yeah, so correlations are going to be higher, especially if you're looking pre-market, like really early in the morning. Liquidity is a big concern, and there's not a lot of liquidity in a lot of things at 5 o'clock in the morning. People who are on cruddy retail brokers don't even have access to trade before 7 a.m. So there's a lot less liquidity. So you got to be very careful with the pre-market trading that you're doing. I generally recommend for people to not pre-market trade, but every once in a while there are really strong opportunities, like the other morning, where it might be worth it to do some very early pre-market nibbling. Just make sure that your size is under control, and make sure you're doing it in something that's liquid. What's going to be liquid? SPYs and Qs and IWM are probably going to be pretty liquid. Apple will probably be pretty liquid, but the average stock that you type up is just not going to be trading and is going to be on a very wide spread. And if you're trying to execute that pre-market, you just got to be very careful. Got to be very careful. Sunny asking, is that technically a bearish engulfing candle? I'm not sure which chart I had up when you brought that up. The SPYs are, though, that you're looking at the SPYs. SPYs kind of more or less engulfed these last 3 days of price action, and a lot of this price action here from early October, November. So yeah, it's definitely a bearish candle. We want to balance the bearishness of this candle with the downside extension, which is why, based on this candle, like if we gap up, and with the way the market's been gapping, honestly, who knows where we're going to open tomorrow. But if we were gapping up to like 455 or higher, you probably want to be looking at shorts. And if we gap down, a few bucks, we gap down to 445 to 447 in the SPYs, and that would probably coincide with that nice, 207 to 210 area that I'm talking about with the IWM. Then you have to balance the fact that these candles are so bearish with that downside extension and a common gap, and probably you're better off buying that degree of extension, not shorting tomorrow into a gap down. Short into a gap up. Don't short into a gap down tomorrow will be my thought process. But we got to assess that in the morning. And so I prefer to do my morning research in the morning when I have the most amount of information. Yep, if the VIX is up, size down for sure. Yeah, I mean, Cap Holmes, I don't look at the Dow that much, but I agree with you, to see some relative strength and something that holds more value type names would make sense to me. What we're not seeing right now is a rotation out of growth and into value. We're just seeing selling, right? Just selling across the board. I forget what the equal weighted ETF ticker is. Natalie asking if AI reported earnings. I'm not sure. Is it trading down here further after hours? No, it's trading up after hours. Maybe it did. I don't know. What's my take on BABA? I talk about Baba a lot. I know you're new here on the team, so I'm happy to repeat myself. I love Baba as a company. I'm a big fan of the stock. I'm a big fan of the Chinese consumer. You know, China has the largest and growing middle class in the world, and they're becoming increasingly consumer oriented over time. I prefer JD over Baba to take advantage of that thesis. But all the same, I think that Baba has a tremendous amount of value at these prices, but there's been no technical signal to buy. And we were talking about this in VTF at one point. You know, you can have your thought process on, I want to be an owner of XYZ stock, but your technicals give you the actual timing on when to execute that idea. And right now, this thing has just been a bloodbath. It's been a bloodbath. This is another one that's on the beat up list. So Alibaba, when Jack Ma disappeared, was at $320, and you know, the Ant Financial thing going along. Before that, Alibaba could do no wrong. It's gone from 320 to 122. A bloodbath. Add it to the list. Add it to the bloodbath list. Sebastian, hey Derrick, with big gaps, 1% plus in the open, is it better to avoid opening trades? It depends on the gap. It depends on where you're gapping to. It's not just the percentage in which it gaps. Like if we had a big percentage gap down tomorrow, I would want to be very focused on opening trades. But today's big percentage gap up was the opposite because of where we gapped to. It was a common gap right back into equilibrium. It was a very large gap up. It was hard to buy. It was hard to sell. So the answer to your question is not necessarily. It depends on the situation. Is the IWM predicting a market crash? I mean, you might be able to make the argument that the market's already done a market crash. You know, we'll see here. I don't know. Is the direct answer to your question. From Chinggis, can you also give your perspective a bit on the money inflows in January? So January was traditionally subject to the January effect, which is bullish. Basically, people who do tax loss harvesting into the end of the year then put their money back to work in January. So January traditionally is also a bullish month. What's referred to as the Santa Claus rally, which typically happens like the last week of December, is actually the market front-running that historical phenomenon of the January effect. So a lot of the January effect has actually been fast-forwarded to the second half of December. So we'll see if that happens again this year. You know, the big thing I always say about when you look at these historical metrics on things, like for example, the IWM is traditionally the strongest index in the month of December, is that's just what tends to happen in the past. It does not mean that it has to happen this year. Yeah, you know, a lot of these companies like Roku for sure. I've been, you know, like I remember on the way up, where did I get smoked in Roku short? Was it in 2019? I remember thinking that Roku was ridiculous at $150. And I tried to short it and I got stopped out at like 173 right before it crashed. So it's the same thing, you know, we got to have some degree of perspective. Look at this double top. Wow. Well, this is interesting, actually. Look at this pattern here. Double top here in Roku. So what's the technical measured move of this? Let's just do it easily. 490. Let's just call it to 300. 490 to 300 is a $190 move. So technically, you'd be looking for $190 a downside. So that would be to 110. Roku back at 110? Maybe. We'll see. Next here from Varun. How is buying snow on earnings a flight to safety quality given its valuation despite their record earnings and astronomical growth? What does that mean, ARC software? I don't understand the second part of your question. But yeah, I mean, you know, Snow is a Warren Buffett name, so that might have something to do with it. But look, even this thing's gotten trashed here for the second half of this month. Did it just report earnings? Did I miss that actually? Oh, that's interesting. That's interesting. That's very interesting. I didn't see the snow numbers, so I missed that one, Varun. I'll take a look at it later. But yeah, market's up for it, so I guess the numbers were decent, or the guidance was decent. From Oriel here, thoughts on Verizon or AT&T as safety plays? Yeah, you know, AT&T splitting off Warner Media. What's the dividend percentage on AT&T at $22? It was like 15% or something like that at this point. I'd be actually curious to know. These things are also destroyed. You know, this market is selling everything. It's not, like I already said one time in this afternoon meeting, it's not selling growth into value. Because if it was selling growth into value, we'd be seeing these XLE names even a little bit better than they are, even though they're still kind of okay. But other stocks like, you know, Viacom or that PBI that we brought up earlier, that I know people look at as value, would be holding up a lot better. And you know, AT&T, that, oh my God, Verizon. You're really curious to know what the dividend percentage is on AT&T at these prices. Whatever LOLs. 10% correction or bounce back from the ADMA. I don't really understand your question there, person from YouTube with a funny name. So the IWM is already having a 10% correction, and even if you look at the SPYs could do both. The SPYs could, you know, typically markets don't go in straight lines. Sometimes they do, but typically they don't. So if the SPYs are going to go down 10%, they still got a lot more to go down. But they could bounce back to the moving averages, create a lower high, and then go down even further, make lower lows. I mean, that's the definition of basically a trend reversal. We're going from higher highs and higher lows to lower highs and lower lows. That could happen as well. I mean, the 200 day is still a ways away also. You know, the 200 SMA for the SPYs is at 428.50. So we'll take that one as it comes. Rich, too funny. Sunny here saying iron, lumber, steel down 25% from highs. Powell statements on inflation seem a little late. Down 50. Yeah, iron and lumber down 50% from highs. Yeah, so we're seeing it in certain areas. Pull back from those inflation numbers and not in others. Where's USO right now? Curious. $48. I don't suppose anyone has seen the price of the pump go down yet. Steve thinks that wage increase inflation may slow. I think that's going to happen also. But energy and food may continue. Well, right now, they've been selling off this USO. But yeah, we'll be paying attention to that for sure. Could get in VTF 5 a.m. like the other day. Maybe if I wake up. I don't know if I'm going to rush to wake up tomorrow morning. We'll see if I'm even able to sleep. This market's been so crazy. I'm not going to promise I'm in the VTF that early tomorrow. I'm sorry. Maybe I will be. I didn't see the print in SPYs at that price. Yeah, it's probably a late reporting of a dark pool, Steve, if I had to take a guess. Oh, AI did report. And they beat. They beat nicely. I guess Snow reported also. From Steve on Baba, do you have a buy point in mind or waiting for a market to stabilize? So I've started to buy and nibble a little bit in Alibaba in my outside brokerage account. But my outside brokerage account I use very specifically for buying and holding. I buy and hold in it only. I don't trade. All of my actual trading I do in my T3 professional account, my swing trading and my day trading. I would love to start buying Alibaba here. I'm not going to catch a falling knife. We need to see a signal. I love these prices though. This 122 price, like, sign me up. Is Baba going back down? I remember buying the $80 breakout in Alibaba. One of the best trades of my career. It was my best trade of my career at that point. I bought this $80 breakout in Alibaba in 2016. I caught this great move to 110. I liquidated my entire position in front of 110, and then I rebought on like the retest of the breakout here near these lows. I bought like $87 or something like that, and then that one I held all the way up to like $180 over the course of these months here, and it was awesome. So we're very quickly approaching the 2016 Alibaba breakout level of $80. All right. Oh, Oriel's saying that AT&T's cutting their dividend. Yeah, shareholders are not going to like that. The only reason anybody is in AT&T is for the dividend. So maybe that has to do with some of the degree of selling there. People who are investors in AT&T, they want to own something that's stable and is just going to give them that yield. And that's why the mashup between Warner Media and AT&T wasn't good, because you had this Warner Media company, which is now mashing up with Discovery, which is going to have the exact same problems. You have like Warner Media, which owns HBO and has like streaming that's going after growth and multiple growth, right? Like similar to a Netflix or a Roku or what happened with the multiple growth that came out of Disney. But you had that company merging with a company whose investor class is entirely focused on steady dividend payouts, and it was just a bad mashup between the two. And now you got Discovery doing the same thing. I don't know if that Discovery Warner Media buyout situation is going to work either, but we'll see. Sure, NamCap. If you watch my technical analysis class part 2 in my training program, if you have access to it, I get into it. The question was, what did I do with Roku for the measured move? So technically, the technical measured move, and this does not have to happen this way, but the technical measured move of a double top is to take the resistance points and the low part of the M, the midpoint of the M, right? A double top is also referred to as an M pattern. A double bottom is also referred to as a W pattern. So you take the resistance, and then you take the low point, and you double it. So whatever this is, I just did it very roughly. I said 490 to 300. Whatever that down move is, on the break of 300, you expect the move to double it. So if this is a $190 down move to the midpoint here of 300 or so, then the break of 300 you would expect to lead to another $190 move. It's already done half of it. It's done half of it this month alone. This market is crazy. This market is crazy. Look at it. It's done it. It's done it this month alone. But technically, yeah, you'd be looking for another 90, 100 points here to satisfy the double top. But keep in mind that double top took, I don't know, a year to build, so you would expect the move to take a significant period of time as well. But so far, they've done half of the measured move in a month. This market is sick right now, I tell you. Natalie asking about Moderna. Yeah, I don't have an opinion on this Moderna. This Moderna has been all over the place with the vaccine news. The market loves the new variant from Moderna because it's going to be a new vaccine. They hate that it's going to take, 4 months to build the potential new vaccine. I know the stock got hit today when the CEO of Moderna came out and said that he thinks that he'd be able to have it by March, and Josh commented that feels like a long way away. I think it feels like exactly what to expect. They said it on day one. They said it Friday last week that it might take them 3 months to build a vaccine update. So March is 3 months away, 4 months away. So who knows what's gonna happen? No problem, guys. All right, let's wrap it up. It's 10 after 5. Crazy day, crazy 2 weeks, crazy market. The fun is not going to stop tomorrow. So I'll see everybody then. Good night.